Hi, Kelly Eckholt here to update you on the key events of the week. So this week I'm going to focus on the outcome of next week's Reserve Bank meeting, which is shaping up to be a real showdown. Financial markets are supremely confident that the OCR will be increased by 25 basis points to 2.5%. At the same time, though, the domestic economics community is split. Three of us think that the OCR will remain unchanged, while the other two believe in the hike. The market's main case for the hike is that they think the Reserve Bank essentially promised a hike back in their May meeting when they forecasted that the OCR would average at 2.51% over the September quarter. They think that the Reserve Bank could somehow lose credibility if they don't follow through on that forecast. But what the market forgets is that quite a lot has changed since back in May, and in particular oil prices are something like 30% lower than was prevailing back then. That means that oil shock, which was looking like a really long-lived supply shock, is now looking like a much more normal, short, sharp shock. And short, sharp supply shocks would normally be looked through, as the Reserve Bank indicated back in March when they started talking about the impacts of the oil crisis. Indeed, the Reserve Bank, in the wake of the May monetary policy statement, noted to media that if oil prices were to fall considerably from the levels prevailing then, the case for a July hike would weaken. It really rather looks like the situation now looks closer to what we were looking at the start of the year, where there might have only been one OCR hike in 2026. I think in the end the Reserve Bank's going to focus on the data here. If you think that the Reserve Bank promised you something, then you clearly misunderstood them. I think the market's got this one wrong. I'll be back to update you again next week.